Hello and welcome. You're watching Business Today Television. I'm Tanya, Aneja. Well, after a long period of underperformance, the Indian stock market has delivered positive returns in the month of April and May. FIIs also have been on a buying spree now for some time. So, is this a bull trap, or is it the right time to become bullish on equities? What should be the asset allocation strategy, and how should one really invest in a rising market? We are going to discuss all this in this episode, and my guest today is Kirtan Shah. He's the founder and CEO of Credence Wealth Advisors. He's very popular on social media, especially his Twitter threads, and he has his own YouTube channel as well, and he explains everything in the simplest yet practical way. Thank you so much, Kirtan, finally for taking the time out and being with us here on Business Today Television.
Hey Tanya, thank you so much for having me on the show.
Absolutely. So, Kirtan, if we talk about the market situation right now, it is bouncing back after a long period of consolidation. So, is this a bull market according to you, or do you see this as a bull trap? And how to really invest in a rising market like this? I mean, where do you want to put your money at this point in time?
Tanya, I think at this point in time, while we look at the very near term, I think you will definitely see a little follow through because there has been a lot of consolidation, like you rightly pointed out. Probably mid cap is just 1% away from the highs. Bank Nifty is 1% away from the highs, right? Except if you look at if you keep aside IT, I think broadly the market breadth is doing pretty decent, right?
Right.
So you will definitely see some follow through because there is going to be a technical angle that will play out. But I don't think there is going to be any runaway rally that probably if we don't invest at this point in time, we'll miss out on something in terms of being left behind to invest at markets at these levels. I think if you really ask me, we've started allocating clients' investments to IT. We feel it is definitely a value buy at this point in time. Banking may definitely play out in the near term, but probably at 44,500 kinds, I think there is decent money that somebody who's already invested in banking would have already made, and probably those are the times where you will want to look at booking profits. And because that's not too far from where we are on banking, I don't think there is a lot of room on banking. Of course, there is a little upside, but not really to make some serious investments at this point in time. So I think you will have to be very, very selective in what you are investing at this point in time. I think IT is something that we are slightly bullish on with a little medium term view because that's a good value buy at this point in time is what we feel.
Okay, be very selective. That's the word coming in. And also, Kirtan, given the retail participation trend that we are seeing right now, do you think equity is too risky for some investors? I mean, how should investors with the moderate risk appetite maximize their returns with lesser risk?
See, I think, Nani, what we have to understand is that while we are trying to do investment, I think our larger goal is to be able to beat inflation, right?
Right.
And if you look at any historical data points, anybody who's been around would know that post-tax fixed income has most of the times not been able to help us beat inflation. So even if you're the most conservative investor, I think even if you have 20-25% of your portfolio invested in equities, even though the remaining part can be in fixed income, you probably might be able to beat up inflation. If you are definitely slightly more moderate in terms of your risk appetite, you can increase the allocation to equity, which was 20-25% in case of somebody who was conservative, to let's say a 40% or a 50% in your case as a moderate investor. What you also have to keep in mind is that, look, except equities, there is hardly any asset class which will really post-tax be able to kind of generate inflation beating returns for us.
Yeah.
But given your risk profile, you will have to choose whether do you want to, what kind of market cap do you really want to invest money in. So if you're conservative, even if you want to put 20-25% of your investments in equity, try and stick to large caps, right? And probably on the other side, if you're slightly more aggressive, is where you can look at mid cap, small caps. So that's how you can limit your exposure to equities and be very selective in terms of what market cap do you really want to invest in, so that the risk does not go out of proportion of what you really are not very comfortable with. I think that's the way you probably are able to maintain the right kind of asset allocation. Um, you might be able to generate inflation beating returns within the kind of volatility that you're okay with.
Okay, absolutely. And coming to asset allocation part only, Kirtan. So, what are some golden rules of asset allocation according to you, and what should be the asset allocation strategy at this point in time? I mean, apart from equity and debt, which are the other asset classes investors can consider?
Uh, Tanya, if you look at the listed space, I think you can take exposure to real estate via REITs. You can also take exposure to gold
Yeah.
through an SUV or a gold ETF, apart from equity and fixed income. I think if you go by the models that we follow, we typically allocate 20-25% to equities, close to 70 odd percent to fixed income, and the remaining to gold for somebody who's conservative. Somebody who's slightly moderate, a 40% equity, a 10% gold, and 50% fixed income is our allocation to somebody who's slightly more moderate.
Okay.
And for somebody who's aggressive, we typically look at an 80% equity, 10% fixed income, and 10% gold. Of course, I didn't mention real estate or REITs here because there are very limited options that you can really play out while you are talking about REITs. And also, real estate is very cyclical in nature, and it's more of a tactical bet than a permanent, asset allocator in your portfolio. So I think from a model, I think these are the three things that somebody has to look at depending on what risk profile that you bring with. Our current asset allocation is slightly skewed. For an aggressive investor, we roughly have 30% of our portfolio currently aligned to long duration debt mutual funds. We have close to 20 odd percent allocation to IT and banking, and the remaining is more diversified in terms of equity. So that's how we are approaching the market currently with a 12 to 18 month horizon.
Okay, absolutely. And since you talked about gold as well, I mean, the yellow metal is also in focus. I mean, gold prices continue to glitter and how, and it hit an all-time high also recently. And I think you prefer sovereign gold bond scheme instead of buying physical gold or digital gold. I saw that tweet and you explained it really well. So, is sovereign gold bond scheme best form of gold investment according to you?
Tanya, 100%. I mean, barring a couple of cases which are very specific to you as an investor, if I have to generalize, I don't see a reason why there is anything better than an SGB, right? You get 2.5% interest. Your capital gains are tax free if you hold on till maturity. Even if you want to exit, you have the secondary markets where you can exit. Of course, there is a tax component that ends up hurting you, but that tax component is anyways a part of any other way that you invest in gold, right? It's just an additional advantage is that if you stay through the course of the holding or the maturity of SGB, the capital gains are tax free to you. So I definitely see no reason why probably you would not want to consider an SGB. But yeah, for a particular case where somebody really wants to use these instruments to time investments in gold, might probably want to look at gold ETFs over an SGBs because SGBs are typically trading at a discount, right? So if you bought an SGB when it was originally issued and then you want to try and sell it before the maturity, you might have to take a 3, 4, 5% discount because that's how they trade in the market. So for somebody
Right.
who wants to really trade and time gold as an asset, probably gold funds, mutual funds, or gold ETFs may make a lot of sense. But for everybody else, I think there is no better alternative than the SGB.
Okay, absolutely. And since you are with us, so I think we should talk about rate hikes also. We know that the RBI has taken a pause and the Monetary Policy Committee decided to keep the repo rate unchanged. But will it be a long pause followed by a rate cut according to you? Or do you see one more rate hike coming in?
Tani, my view has been very clear for quite some time. I think India has not really seen any huge inflation-related problem, and the RBI has done a phenomenal job, right?
Absolutely.
Then the question is, then why did India raise interest rates in continuation? And the answer to that is very simple, is because the global rates were going up. And whenever you see global rates typically go up, right, USD as a currency strengthens, and rupee, which is a local currency, depreciates. So if you really ask me, the last one or two rate hikes that have happened in India has not happened because we were facing inflation challenge. But had we not increased our rates, rupee would have fallen more. And that is a much bigger concern to RBI than inflation, because inflation was actually not a concern, at least for the last 2 quarters.
Right.
Uh, Now that there are clear signs, I would not say clear, but I think now that there are decent signs in the US that probably they will start taking a pause because their inflation has stabilized, and which is why you saw dollar reacting the way it did.
Yeah.
I think RBI will definitely take a pause, and if things stay the way they are and better from here on, we definitely might see a rate cut also before the year.
Okay, absolutely. So that's the word coming in. And also, Kirtan, we just stepped into a new financial year. I mean, it's important not only to focus on what to do, but also, to make sure what to avoid. And it's also important to identify mistakes and not repeat them. So, any mistakes that, investors should avoid, while planning their financial journey, especially at this point in time?
I think a lot of mistakes. So let's say, for example, if you've seen, let me talk about equities, right? Now that you've seen markets move up from 16,800 to 18,300 or 350 in such a quick span, right? A lot of us will typically end up having the feeling of having missed out, and probably this is the biggest reason why a lot of money will start pouring in at the peak of the markets, where new money will come in with an expectation that they will see the same kind of rally that they saw from 16,800 to 18,300, 350. So I think don't kind of jump the gun in terms of feeling that you missed out. At this point in time, if you really want to invest, don't invest in sectors that have already ran up so much, but try and look at value buys, like say we feel IT is a good bet from a 2 year, 3 year perspective at this point in time. Very similarly, when you look at fixed income also, Tanya, I think if you look at the last 3 years, you will see how low duration funds and short duration funds have done so well, right? But this is actually not the time to invest money in low duration kind of funds. This is the time for you to look at investing in medium duration funds, because the rates are expected to fall. So I think if you keep these two things in mind, and also for gold, I don't think that gold really has a very strong upside from here on, and hence don't look at the last 12 months or 18 months of rally in the gold and try and jump. So largely what I'm trying to tell you is, don't get carried away with the last 6 months, 12 months performance on the asset class and jump because you probably are feeling that you missed out on the rally. Take your time, look at what value is available in the market and invest accordingly.
Absolutely, golden words coming in. And also, before we let you go, Kirtan, just want to, just want your thoughts on multi-bagger stocks as well, because we are always after multi-bagger stocks and wealth creators. So, how do you select your wealth creators?
I think very honestly, if you really
Is
ask
there any
me,
secret formula that you use?
there's absolutely no secret. I think in investments, the simpler you keep your investments, the better it is. I think, but what I've learned uh, uh, with my little investment journey is that it's actually not the stock, but the sector which generates the kind of returns that you have to generate. And I keep telling people that, had in 2020, had you picked the worst of the pharma stocks, you would have still made more returns than picking the best of the banks, right?
Right.
So I am somebody who believes that if you're able to identify the right kind of sector which will play out over the next 3 4 years, and even if you end up investing in the worst of the stocks in that sector, you will end up doing well than the broader markets. So my theory is very macro. I look at top down, so I'm more concerned of how global and Indian macros are changing, and basis that I try and identify which sector will do well, and hence then the stock in it. So no real magic in this, but I think if you are able to understand probably which sector will play out in the next 4 5 years, I think you will be able to do a much better job in investing.
Okay, I guess it's all about the sector only. And on that wonderful note, thank you so much, Kirtan, for taking the time out, sharing all these valuable insights, and being with us here on Business Today Television. Thank you.
Thanks for having me, Tanya.
Okay, with that, let's wrap up this episode. But don't forget to follow us on our social media platforms like Facebook, Twitter, LinkedIn, Instagram. You can share your stock queries, stock feedback. So stay tuned for all the latest market updates, and many thanks for watching.
If you like the video, do like, comment, share and subscribe.